showing.
Well, good morning, everybody. My name is Jim Codney, National Sales Director here at Western Marketing. I sincerely apologize for the delay. GoToWebinar has changed the way they have the webinar start, and we were having some issues. So for those of you still on the call, we greatly appreciate it. Today we are joined by partners from Industry Leader Brokers International, Kyle Veenstra, who's the Manager of Training and Development, and Brad Weber, who is Business Development Consultant. So for those of you who haven't worked with me directly in the past here at Western Marketing, Brad's who I call if I don't know an answer to a life question. So a lot of knowledge on this call, even above and beyond me. So a couple quick housekeeping things. First of all, we're here for you. If you have a question, ask the question. We'll get to questions at the end of the presentation. If you don't get your question answered, on this webinar, because it's on a specific case or something that we don't think will benefit everybody as a group. If we don't answer it, don't worry. Somebody from our team will contact you after the webinar and try and help you out. Also, I know you're not out on appointments or sales when you're on a call with us. So we're going to try and make this informative, relatively brief, 30, 35 minutes plus a little time for questions. So with that, I'd like to introduce Kyle Veenstra. Kyle, take it away.
Well, thank you, Jim, and thank you for everyone for joining us. For today's session, we're going to dive a little bit into Index Universal Life. And really what we want you to get from this would be, what's that typical customer that might make sense for an IUL? What does he or she look like? What are some of the things that they're concerned about? What are some characteristics, some general ideas of kind of what that person looks like? Now, this is very generic. This is a case study we use to kind of get people who are brand new to life insurance to kind of start thinking about IULs and, who might be a good fit. But as I go through this, we'll probably, we'll talk about this particular profile, but also kind of in general, where we kind of see people purchasing IULs. And then on the back end of this, we'll actually show you kind of how you put together an illustration and how you might talk about that. What are some of the important things that you want to mention? What are some of the key things? What are some of the key things that you'll want to focus on? Maybe some of the things you want to stay away from. So, and Brad's backing me up here too, so I'm sure Brad will jump in here and give you his take on some of those things, because as Jim says, really good resource. He does this on a daily basis, and someone that I lean on as well too, Jim, for help on specific things. So let's dive into this one. So we got a husband, 45, married, his wife's 40, and they got 2 children, 10 and 6. Now, the one thing I'll mention on Index Universal Life, typically, you're gonna see these being probably most popular for people in their 30s, 40s, and maybe early 50s. And the reason I say that is that for Index Universal Life, particularly ones that are cash accumulation focused, where the client really likes the idea of putting money into an IUL, having some death benefit protection, but really their goal is to generate cash value that they're going to access in a later point. You really want a nice time horizon for that funding of that policy, for that growth before they start accessing it. So that's where we see people in their 30s, 40s, late 50s. Now, you may run into a young person that kind of has his ducks in a row or her ducks in a row, and they start funding that policy in their mid to late 20s. That's great. I have seen it before, but typically, in my experience, it's usually people that are a little bit more established, 30s, 40s, and 50s, where we're seeing a lot of IULs come from. In this example that I'm running through here, I have a husband that's working and a wife that's stay at home. Now, in this sales scenario, we're actually going to kind of use this as a 2-person sale. One of the things that I run into a lot is when you have someone who's either exclusively the sole income in a family, or the primary breadwinner, where you have someone that has a larger salary compared to the spouse. Sometimes we see that stay-at-home parent, or the person that maybe is working part-time. A lot of times we see from a life insurance perspective that second person isn't getting any coverage at all. So in this example, we're going to talk to the husband about an IUL, but also getting some coverage on the wife, because the things that she does at home is very important. If something were to happen to her, that surviving spouse would need to come up with some money and some resources to be able to help take care of the kids. Now, from a retirement planning perspective, the husband's contributing to a 401k. And from an existing life insurance perspective, he has some employer-provided group term. Now, I know a lot of folks are kind of new to their life insurance journey. One of the things that you'll run into a lot is people will say, I already have life insurance, and a lot of time that is insurance that is provided through their employer. It is a fantastic benefit. Usually it comes at zero or no cost, to the potential prospect. So they'll say, I already have life insurance coverage, and indeed that they do. But if the insurance that they have is exclusively through their employer, there are some issues with that. Namely, one, they don't. If they were to leave that employer, whether that's they find a new job, they get fired, they retired, they're going to lose those benefits, right? So in my estimation, it's always good to have to take advantage of employer-provided life insurance. It's a great benefit. As I mentioned, usually there's very little or no underwriting that's involved with that, and usually from a cost perspective, an employer will provide 1 or 2 times their salary and have the option for them to purchase more life insurance. So one way that you can gain credibility with a potential prospect is to definitely tell them, take advantage of any life insurance benefits that are provided through their employer. Even look if you can purchase more. It provides you credibility because, one, you could potentially get them more coverage at a low cost, but 2, you're showing that you don't have to necessarily always buy it from you. You're trying to overall look at their life insurance that they need and get them as much coverage as possible. So that's one of the things that I found when I was selling. Is when you go to the prospect and you kind of look at their situation from a total standpoint and say, hey, take advantage as much of the employer insurance as you can. There's some downside to it, which you'll explain to them, but it does lend some credibility that you're looking at all angles on how to get them some coverage. So now that we've kind of established what that potential client might look like, what are some of their goals or concerns? What are some of the things that they're worried about? Well, the first thing that comes to mind is really providing that family with income replacement in the event of a premature death, right? This gentleman's 45, has 2 kids, 10 and 6. Probably safe to assume that his income is very important to that family. It's probably something that he's concerned about if something were to happen to him, to make sure that his family's getting some income to replace what, his earning power if something were to prematurely happen to him. In this example, he's worried about saving money for his children's further education. We hear that a lot, right? A future funding idea. Maybe they haven't set up college funding yet for their 2 kids, but it's something that they're worried about. And this is a big one. Having enough income at retirement to fund their current lifestyle. That's essential to the IUL conversation. This is an idea where you're funding a life insurance policy with the idea that at some point, as you're getting close to retirement, that you're going to take the cash value in that IUL and start taking distributions out of it tax-free. That is the key value proposition when it comes to index universal life. So the fact that this family is worried about income at retirement to fund their current lifestyle, that's a ringing alarm saying an IUL might make sense for this couple. And another thing that might come up is market performance during the distribution phase of retirement. For this gentleman, he's putting money into a 401k, and I don't want to get too heavy in kind of investment talk, but just keeping it real high level, a 401k would be qualified money, meaning the government hasn't taxed that money, and it will get taxed when they start taking distributions out of it. So a lot of times people are worried about when they're getting when they're putting money away for retirement, they're trying to hit a certain number, right? They want to have $1 million at retirement, 1.5, $2 million, $500,000, whatever that number is. They want to hit that retirement goal, but that's only part of the equation. The second part is, how do you access that money in a as efficient as a possibility? And when you have a lot of qualified money, being this is mainly the only place that he's putting his money away in his 401k, remember, when he starts taking money out of that, he'll start his distributions will get taxed at that point. So even though he might have a nice amount of money in his 401k, as he's taking distributions out, the balance is going to drop by the distribution. It's going to drop by the taxes that are coming out. And there's also this concept called sequence of returns risk, meaning not only is he taking money out, his balance is going down, not only is the taxes coming out of that, but also if the performance of that 401k were to lose money, that's also a third thing that could start reducing that balance very, very quickly. So that's what we refer to as sequence of returns risk, and that we don't know what the tax environment's going to be. We don't know what the investment environment's going to be. He's 45. Let's say he retires at 65. In 20 years, the landscape could have completely changed. So having only qualified money could be a diversification issue in that, if he's losing money from taking distributions out, getting taxed, as well as those underlying assets not performing, his retirement income could be reduced significantly by those elements. So it's something that he's concerned about, and an IUL might make a lot of sense. So what are some good questions that you could ask somebody to kind of to get a feel if an index universal life and or life insurance makes sense for this couple? I do love this question. It's a great one. It's the first one is, really trying to understand that picture of what would your family situation look like without your husband's salary and benefits, right? This family is very, very dependent on that. It's a one income family, and that salary is very, very important to that family, as well as the underlying benefits that he's getting provided, right? So asking them, what's their family situation going to look like if that husband's salary and benefits weren't there, really can evoke some emotion on kind of what that situation might look like if he's no longer able to be here and generating income and benefits for his family. Another great question to ask would be, what happens to your employer life insurance if you're no longer working or you switch jobs, right? We mentioned we want to touch on that. It's great that he's getting life insurance through his employer, but we also want to make it a real situation in that if you left that company, whether it's switch jobs or you're no longer working, retired, get let go, what happens to that life insurance? Now, most employer life insurance, if you're no longer working there, they're not going to have, you're going to lose the coverage. Or if you want to keep the coverage, you can essentially convert it into your own personal plan. However, it's usually very, very expensive, and usually the product that they'll let you convert to isn't really that great. So essentially, that group term insurance it's a nice benefit while you're working there, but it loses its appeal once you either leave the company through your own choice or retirement, or if you're let go. This is another great question, and it leads to when we're talking about maybe getting some insurance for that spouse that's either working part-time or not working, or doesn't make as much money as the other spouse. What would your family situation look like without the mother's contribution to the home? I kind of call that the CEO of the home sales idea, right? What are all the things that she does that her role within that family unit, and how do you put a monetary number on that? It's very hard to do. I think everyone can agree, if this husband were to lose his wife with a child, two children, 10 and 6, he'd probably need to have to come up with some money from whether it's getting a nanny, daycare, a lot of different expenses that go in there. Who's going to maintain the home, a lot of different things that he's now on the hook for that he might not have the time or energy to do. So having life insurance on that other spouse makes a lot of sense. So we can go back to her and say, does it make sense to get some term insurance or get herself an IUL? Another opportunity to sell some more insurance and help this family out. Another good question you could ask, if you're retired and living on your 401k funds, how long would that last? Are you safely invested? Are you subject to loss in a risky market? Now, one thing to note on 401ks, a lot of times they're done through what we call target funds. So you'll and some of you on the call may have 401ks or worked with them in the past. A lot of times you'll be funding those, and those 401ks will start to, as you get closer to retirement, they'll start allocating more of those dollars into less risky assets. However, with a 401k, you essentially, it's very difficult to completely protect it into assets where there's no there's no possibility that they can lose money. So making that awareness, saying, it's good that you're funding a 401k. It's a great product. It's a great retirement solution, but there are some risks with the 401k in that, if markets are down, particularly when you start accessing that money, that money can shrivel up very, very quickly based off the withdrawals going out, the taxes, as well as potential market losses. As we're diving a little bit more into this gentleman's situation, you may want to check and see, are you contributing to your company's 401k above the match? Now, again, we don't want to get too heavy in investment principles. However, just asking them, essentially, are you maximizing your match with your 401k, right? You don't want to leave money off the table. So if that company provides a match up to a certain point, you want to make sure that the client's doing that. Another good question you can ask is, do you anticipate taxes going up or down in the future? Now, most people are going to say up, and we're really leaning into that because one of the benefits of funding an index universal life is, as you're funding that policy, that money is growing tax deferred. However, if we follow some simple rules, when we start taking money out of our IUL, if we do it the proper way, and we're going to show you how to do that here in just a second, is that money is received via loans, and those loans are considered tax favored if we follow those rules. So we want that client to start thinking about tax efficiencies. And we love that you have the 401k, but we know you're going to pay taxes on those distributions. Does it make sense to have an alternate retirement asset that you have this money in an index universal life policy that you can start taking distributions out of those tax-free? It's a really powerful conversation. So we want to get that client thinking about that. Now, typically when you sell an IUL, you may have a death benefit target that you're trying to hit, but a lot of times how we see IULs being sold is you uncover a budget. You're going to try to find out how much money can you put into the IUL, and then we're going to reverse engineer it and come up with a death benefit that, and I'll show you how this is done here in the next section of this training. But we're going to show how you take that budget, put it into an IUL, get them some death benefit protection. However, the main primary goal is generating that money tax-free within the value of that IUL and access it in a tax-favored way. So we want to uncover that budget. You can do this a couple different ways. One of the ways that I've seen is, asking a family, how much money do you think you waste on non-essential items each month, right? Could you take half of that and put that money away into IUL? I've seen that as an effective strategy where you can uncover a budget where it doesn't seem too strenuous, right? Asking a family, how much money on non-essential things do you think you do in a month? $700-800, could we put $400 into an IUL, still give you room to kind of do those things that you need to do, even though they're not essential, but can we take some of that money and divert it into an IUL that can provide you death benefit protection and cash value accumulation that we can access down the road? And this is kind of the last question that I really like to use is, if I could show you a solution that captures gains during upward movements of the market, provides downside protection from negative returns, and has potential tax-favored distributions, would that be something that you're interested in? When you frame it that way, most people are going to want to hear more about that, right? If I can show you a solution that captures gains during upward movements of the market, provides you downside protection from negative returns, and has potential tax-favored distributions, is that something I could show you? Most people are gonna say yes to that. Now this part here, I'm not gonna dive too deep into that, but if we're kind of thinking about this conversation, let's assume that it's going really, really well. A lot of different things that you can do to kind of move that conversation and get it closer to a sales scenario. But essentially it comes to taking that information, working with Western, working with Brad here at BI, and kind of finding out what products are out there that would make sense, right? But the key is getting them excited about the idea, uncovering, what type of budget do we have to work with, and then we can get to work finding a solution. So that kind of leads us into our next part, is how would I set up this illustration, this hypothetical, this proposal to show the client? So in my example here, we were able to uncover a $400 monthly premium budget. Now remember, an index universal life, it's a flexible premium product, right? We have our minimum premium, which essentially covers the cost of insurance and the expenses, and we can go all the way up to the maximum premium, which is essentially putting more of those premium dollars into those cash accumulation the index crediting strategies, right? It's a flexible premium. So what we do with that is typically we're going to take that $400 monthly premium, that's what we uncovered. We're going to solve for the minimum death benefit, and we're going to use an increasing death benefit while we're paying premiums. In this scenario, I'm going to pay that premium until age 65. When they're done paying premiums at age 65, I'm going to switch that death benefit to a level death benefit. So stopping right there, essentially, I've created a illustration where we're maximizing those premium dollars. So as much of the premium that can go into building cash value while still keeping it tax favored, we've achieved that. And the plan will be at age 65, once I've stopped paying premiums, I'm going to level that death benefit out, then I'm going to solve for a projected distribution of loans coming out until that client is age 90. So let's take a peek at what that might look like. I know this might be tough to see on the screen. This is an example of an illustration. So I'll kind of walk you through it. And I isolated kind of where we've gotten to a point where the client's 65, they've paid their premiums in, and we're going to start taking distributions out. So as I would talk to a client about this, let's talk about the key things here. So initially, we have an initial death benefit of $75,000 that is increasing. So as we're paying premium and the value of the contract is growing, they're going to add that amount to the death benefit. So we'll see the death benefit grow as the cash value in the policy grows. We can see we did a $400 a month premium, so that equates to $4,800 a year. Now, when I look at an illustration, there's going to be three kind of key areas of what the possibilities are, right? We have on the left-hand side, that's the guaranteed side. Now, from a sales perspective, we don't want to spend a ton of time on this. because of regulation, we have to show kind of the worst case scenario. However, there's not a lot of sales spin to that left-hand side of the illustration right here. Essentially, what it's showing is no growth in the index strategies that we chose, and essentially it's earning just the minimum account value of 2% the entire time. Another thing to consider too is it's also showing the maximum cost of insurance and monthly charges allowable on that policy. So again, truly it's your worst case scenario. You don't want to focus a ton of time on that. On the columns in the middle and the right-hand side, we kind of have a midpoint example. This is showing a 4.5% return based on current charges. That's your non-guaranteed alternative. And on the right-hand side, it's going to show the illustrated rate that you selected, whether that's the maximum illustrated rate or you input in there something else. These are the two sides that you want to spend the majority of your time on. And let me show you how I would do that. So if we take, and again, I know the font is rather small, so I'll walk you through this kind of as best as I can. So in this example, it was a 40-year-old, so we paid 25 years of premium. So we got to this point where we're paying our $4,800 a year. If we multiply that times 25, that's $120,000 of premium. My first thing that I like to do is show them kind of based off of kind of the illustrated rate that we used. We're now sitting at almost $230,000 of cash value, and our death benefit has grown to over $300,000, right? But even if we go back, if we say, well, let's say we don't quite earn that 6.6% through the life of the contract. What if we only get 4.5%? Well, we're still at $170,000 of potential cash value, and the death benefit has grown to $245,000. Now, even in a worst case scenario, again, this left-hand column, this is not going to happen, where in this example, we used an S&P crediting strategy. It earns nothing for over a 25-year stretch. Not going to happen, but we do have to show kind of that worst case scenario. Even in that example, we still have $107,000 of cash value, and our death benefit has grown to $180,000. Again, I wouldn't spend a ton of time on the left-hand side. We want to focus on these two middle columns, but showing, we're not going to emphasize that far left-hand column, but worst case scenario, there still is some cash value in there and some death benefit that we can start taking distributions out. So I like kind of, when you pull up a full illustration, it will show you, I did the math here, 120,000 of premium, but I do like that, I can kind of level set saying, hey, we're getting to that point where we're close to retirement, looking at these, what the possibilities are. I think we can feel comfortable saying you should have between $170,000 and $230,000 if we pay the premiums and the policy performs like we think it should. You should have access to a nice account value that you can start taking distributions out tax-free. So now let's flip that thinking and start talking about the distribution phase of kind of the sales concept. So remember, we were doing an increasing death benefit while we were paying the premiums. When we get to the point that we're going to start taking distributions out, we stop paying premiums and we start taking distributions out. In this example, we're using a loan, and first loan that we can take out, again, this is a distribution showing them taking loans out from essentially age 65, at the end of the year 65, age 66, all the way to age 90. We can take out a loan tax-free of potentially of $25,000 a year. Now, if you think about that, remember, that's a tax-free loan. If you're looking for a taxable equivalent, right, depending on what their tax bracket is, this would be like them taking $40,000 or $42,000 out of their 401k, because it's tax-free and it's a loan, and we followed those rules to make sure that the distributions will be tax favored. That's a very compelling argument. And again, it provides that nice idea that there's going to be some supplemental retirement income that we can take out of this index universal life. We did a good job planning, funding this IUL. Now we can take out the benefits, right? And again, another key thing to remember, through this entire time, we were providing that person death benefit protection, right? If something were to prematurely happen to him, that death benefit would go to his beneficiaries, income tax free. In this example, though, because if we're talking about it, he's alive still, he's ready to retire, and now we can start that distribution phase. We can take out tax-free distributions to help supplement his retirement. A very, very powerful conversation. Something else I'll note too, I always know it's a good setup when I look at that last premium payment, $4,800. When that first loan comes out and it's essentially 5 times what we put into the pot, 5 times that annual premium we were putting in, I think that's always compelling too, right? You just got, last year you put a $4,800 premium in, we stopped paying premiums and we're to start taking distributions out. That first one being around $25,000, that's a good return on on that premium that you put in. I like to see that last premium seeing a 4 or 5 times increase on the distribution coming out. I think that's a really solid value proposition. And let's think about that overall. If this client were to get to this point and have, roughly between $170,000 and $230,000 of account value in that IUL, if I think about that, I paid $120,000 of premium over 25 years. If we do the math on that, by the time he takes his 5th loan out, he's going to have gotten all of his money back. So basically, any loans that he gets out on top of that is essentially going to be above and beyond what he put into the policy. I think that's a strong conversation as well too, saying you paid premiums for 25 years, we start taking loans out, in the 5th or 6th year, you've already gotten all your money back, and now any distributions you get beyond that is essentially gravy, right? And oh, by the way, if you were to pass away during that distribution phase of the policy, there's going to be some death benefit coming to your family, income tax free. It's a powerful combination of death benefit protection as well as tax deferred accumulation. And then we're showing the power of the tax-free potential of those distributions coming out when we get to that point. We're ready to activate the policy in that way. I'm going to stop there. Brad, anything that I'm missing or something that you can think of as we're kind of going through this?
One additional thing I would just mention is if you are working with a client and they say 75,000 is too low for the initial death benefit, as Kyle explained, the way it's set up is to maximize cash accumulation for this type of product, but the death benefit increases over time, and they want more death benefit than the 75,000. There are carriers where you can blend in a term rider as well for the primary insured, so you could get them some additional coverage on that same policy and in that same contract if that was something that they were interested in or concerned about the initial death benefit starting low or too low. We could look at some scenarios with options there as well.
And Brad, that's a great point. Another thing that you can do too is I have seen financial professionals who will do a level death benefit too. Maybe death benefit's more important. He or she, they like the idea of the cash accumulation, but having a little bit higher starting death benefit. We can do this as a level death benefit. Now, you'll still pay that same premium, but probably your distributions are going to be a little bit lower because over the course of time, more of your dollars are going towards the cost of the death benefit. But that's an option that you have too. Really it's just getting a full picture of kind of what the client needs. In our example here, right? Remember, this gentleman had some term through work. that he was happy with, that maybe was covering some of those larger death benefit needs. And in our example here, the cash accumulation was the most important thing. But as Brad mentioned, we have some options too, some different carriers that we work with. We can blend in some term. We can try with a level death benefit and kind of see how that works. But a lot of different routes that we can take. But to Brad's point, that starting death benefit might seem low to them, and we can work in some term. We can look at a level death benefit, a lot of different things that we can do. But conceptually, I want you guys to grasp kind of how I would talk through this and kind of set this up. And then the last thing that I'll show you with Index Universal Life is this concept called living benefits. Um, Living benefits is an important conversation to have too, because it provides a kind of a self-completion to this kind of plan that we're putting together, right? In a perfect world, this client would pay that premium for 25 years, start taking distributions out and have it supplement as retirement. But as we all know, things change, things happen. One of the really nice benefits that most index universal lives have is this concept called living benefits. So these are built-in features that provide chronic or critical illness if something were to happen to the client, a medical situation. So for this hypothetical that we ran, this IUL has living benefits on it. It provides two, we'll talk about terminal illness here, but the two that I like to focus on would be chronic and critical illness. If this client were to have a chronic illness, and this example we're running at age 75, if he got into a situation where he was unable to do 2 of 6 activities of daily living or have a severe cognitive impairment, he could accelerate his death benefit and it could pay out money to him and his family if he were to be deemed chronically ill. Another nice benefit is a critical illness component to it. The chronic illness would be an annual payout. Critical illness would be a one-time lump sum payout. For example, if he were to have a heart attack or a stroke, kidney failure, those are some common ones. There's usually 10 to 12 kind of covered, triggered medical situations, but these are important to note too, because most people can grasp that at some point they're going to pass away. A lot of time people, really don't have a plan if they were to become unable to take care of themselves. So having chronic illness on there is a nice additional benefit that I always like to mention, just because it shows that the policy can potentially provide benefit even if they weren't to pass away. We know the benefit of the cash accumulation coming out. However, having this plan put in place, if they were to have a chronic or critical illness, there is some opportunity to accelerate those benefits and get a payout even though they haven't passed away. And then on this policy as well too, there's a terminal illness rider. So if they were to be deemed to have less than 12 months to live by a medical professional, they can accelerate a portion of that money as well in the form of terminal illness. So again, additional benefits beyond the death benefit, the cash accumulation that we're talking about. It really provides an overall value proposition to the client that a lot of people are intrigued about. And something I will note is, in my time with Index Universal Life, especially when you're talking to someone that's 35, 40, right, with a young family, these are nice benefits to have on the policy because they know it's something that's not going to affect them immediately, but if they can set up a plan where they're getting some death benefit, they're getting cash value accumulation, and they also have this chronic and critical illness protection in there, I've seen this really be something that helps move people to buying an IUL beyond just the death benefit and the cash accumulation. Brad, anything to add on living benefits?
Nope, I think you covered everything there. Thank you. Are we seeing any questions from the field? I don't see any in the chat.
Yeah, we have a couple actually.
Okay, perfect.
So Kyle, whenever you're whenever you're done, we can rock and roll through those as well.
Yeah, let's jump to some questions.
Okay, so first of all, the first question is, when there's distribution, the death benefit decreases, or that's the question. Does the death benefit decrease as distributions are made from cash value?
Correct. Yes, it would reduce the amount of death benefit that the beneficiary would receive if there are loans that have been taken and have not been paid back. Generally, the way we're going to illustrate is with those loans accumulating within the policy is how it would be illustrated. So yes, the death benefit is being reduced by the loan and any interest accumulated on the loan.
Yeah, and with those loans, even though we're calling them loans, correct me if I'm wrong, Kyle, you said they do not have to be paid back. Is that correct?
They don't, and typically people aren't going to pay them back. They do have the option to do that. The only time I usually see that is if someone has, they want to move to a different policy and they might have an outstanding loan. Sometimes a client may pay that loan back to be able to move it to a different policy. But essentially, when you're running an illustration, we're baking in, both the loan and the loan interest, and you're seeing the death benefit reduced by that. But remember too, even though that you've stopped paying premiums, that cash value is still growing in that policy based off the performance of those index crediting strategies as well too. So a lot of times people look at the illustrations like, wow, shouldn't that cash value and that death benefit be, moving down more rapidly? Remember, even though you're not paying premiums anymore, you still have the ability to have that cash value grow by the performance in those index universal life crediting strategies. So that's a question I'll get a lot too. It's like, well, I'm taking these loans out and there's interest on there. Why isn't the death benefit and the cash value going, reducing as rapidly? It's because there's still performance in the policy that keeps that cash value going. And this is also important too, Jim, is when we get into the the distribution phase, you want to make sure that the client is monitoring, on an annual basis, kind of, how that loan is affecting the policy. Because the one thing we want to make sure that doesn't happen is we don't want that policy to lapse, right? So generally, when we're running these projections, we're leaving some cash value in there. We don't want to completely demolish the policy because we don't want it to lapse. But there's mechanisms within the insurance carriers as well too, like they don't want that policy to lapse either. So you want to keep your eye on that as you start taking distributions out. But generally, that was a long answer, but generally, no, people don't pay those loans back because they're seeing the tax favored status of that loan. They've done a good job generating cash value. Hopefully at age 65, their death benefit need isn't as great. So now it makes sense for them to start taking those loans out tax-free to help supplement their retirement income.
Okay, great. The next question is, in your case study, is there a specific carrier that this case study was about? Was it North American, NLGs, any specific one, or was it a general case study?
Yeah, we just it wasn't directed towards any individual carrier, and we did that purposely, right? It's just more of the what that client might look like, what are the things he or she is concerned about, and really the insurance carrier is kind of secondary, right? We can find a great solution for them, but we didn't base that off a certain insurance carrier. It's just more of a general example of people we see buying IULs, and then we can fit them with the right product, the right carrier.
Okay. And
Jim,
then the next
Jim,
question.
sorry, can
Yes,
I
Brad.
add a couple more cents to that? Any situation that is provided to us, what we'll do is we'll run it through our multi-carrier software, and we'll make sure that we're providing the best options of all the carriers that we offer, that Western Marketing offers to you as agents, to make sure we're providing you with a solution that best matches that scenario for your client. So we're carrier agnostic. We're not specific to one carrier or another. Now there are carriers that have products that really fit this mold and do it really well. So we'll work to find that carrier that fits your exact client scenario the best.
Okay. All right.
You, Jim?
Thank you.
Sorry. You bet.
Yeah, no worries. The next question, and we've got a few, so this is great. It means it's prompting thought. So the next question is, since the premium is flexible, how do we keep from exceeding accumulation and lose the tax advantage of the growth?
I can take a stab at that, Kyle. So the way
Yep.
it will be set up generally is that the client is paying the maximum premium. So whether that's monthly or annually, it's going to be set up to maximize that cash accumulation. Certainly work with us, work with the carrier if the client comes upon a windfall of money. Maybe they inherit some money from someone somewhere. Maybe they're rapidly growing um, in their industry and their salary is increasing and they love this idea so much they want to put more into it. We could look at doing a face increase. We could look at purchasing a second policy. There would be some options, but you would want to make sure, especially the way that we're generally designing them, that you're not just going in and putting that additional cash into that policy. Now, if you're on a monthly withdrawal, it's going to withdraw that same amount, so you shouldn't have any of those issues. But maybe if the client's paying annually and they're being billed and think, oh, I'll just send a check for, an extra $5,000 or 10,000, whatever the case may be, you would want to make sure, as the agent, that you would work with either us or Western Marketing or the carrier to verify what that maybe max single premium would be, or what other ways that we could design it so that it does keep that tax favorable status.
And
Yeah.
Brad,
So
Go ahead.
go ahead.
Brad, correct me if I'm wrong too, is a lot of the carriers as well too. They will, if you were to send a premium that's kind of
Seated.
it exceeds it, typically they will two different things. They'll either notify you saying, are you sure you want to do this? This is going to, lose the tax favored status. Or some of the carriers will actually force out money to still keep the tax favored status in play as well too. So there's some guardrails there.
Yeah.
But to Brad's point, typically, we see it on a monthly basis, right? That's most of the time how people want to pay their premium. Not always, but a lot of the times. If you're sticking, if we stick to a monthly pre-authorized withdrawal, based off of, in our example, we use $400 a month, right? They shouldn't run into any concerns about losing the tax favored status of the policy. Great question.
Perfect. Thank you. Okay, we've got a lot, so this is super cool. We had a question about somebody missed the start. Folks, you will receive a link to the recording of this webinar here by tomorrow in your email. So everybody who attended will receive this recording. So if you have questions from that you missed, definitely just let us know. The next question is about renewal cap history, that there's some criticisms that agents have heard. They listed a carrier, but what do you guys think of that? Like, how do you see renewal cap history and stuff with IUL?
It'll vary probably from carrier to carrier. I know there are several carriers that tout that they treat their in-force block of business the same as their new customers. There are some carriers who probably don't do that as well. Yeah, I won't I won't specifically name any names, and we'd have to work with carriers to get that history. A lot of them anymore, we'll post that information on their websites. So yeah, there is the potential that caps and participation rates can change. Those are non part of the non-guaranteed um, portion of um, the index universal life policies. I would hope that carriers are being pretty diligent about that, because otherwise they're going to lose a lot of
Mhm.
agents and clients and new business. Unfortunately, we don't have control over that, but certainly hope that carriers are being um, true to their in-force block and their current customers, and working with them the same. But there are some carriers who may not be doing that, and that's unfortunate.
One thing I'll note on that too, Brad, is, you know, something you'll want to be aware of too is if you see outlier cap rates, right? Generally, when you run, if you kind of look at everyone's S&P 500 cap, a lot of times they're in the same ballpark of each other. But if you see an outlier one where they're offering a huge cap initially, I always pause at that a little bit, right? Because you think about the sustainability of that is very, very tough. So as you get more in depth into talking about index universal lives and looking at the different products that are out there, you'll notice sometimes people will release strategies that look a little bit too good to be true, and you're probably right on that. So stick to kind of those comfortable crediting strategies, and they should be in line with kind of what others are offering. If you see an outlier, again, and that might be, for you, it's like, hey, let's just let's try to get that really large cap for a while, and worst case they're going to start reducing it down. But I do note that you can see when sometimes carriers introduce a new product or a new strategy, it'll look very, very appealing. Just be mindful of that, right? Because a lot of times the different carriers we work with, usually they're all in the kind of the same ballpark of each other. If there's an outlier, I would question, how long can they sustain that really good cap? It brings up a pretty compelling point.
Yeah, and the only thing I would add to that is I think the market and distribution is more aware of that now than we were, say, 3 5 years ago, both on
Agreed.
the IUL space and on the indexed annuity space. So you're seeing carriers be more transparent with what
Hmm.
their historical rates have been. Um, so great question. I think we're in a better spot today than we were a few years ago. But with that said, definitely, feel free if you're writing an IUL, let's talk about that. Bring that up to our team, and we can do our due diligence to put you in the best situation when you're talking to your clients. Um, Next question, and I think this is variable, but going to depend on the situation and the product and the time. But do you guys have a rough idea how much interest is charged for loans on IUL?
They can.
Yeah, I would. Yeah, go ahead, Kyle.
No, I think you're going to say exactly what I was going to say.
It's going to vary from carrier to carrier. I would say general ballpark of an indexed or participating loan, you're probably in the 5% range. With some of the guidelines as well, with AG 49, AG 49B, the arbitrage, meaning the difference between the index and the interest crediting rate, was moved down to a half a percentage. So it's not nearly as large as what it was before, in terms of what you could illustrate between the difference between what the interest rate was on the loan and the index interest rate. So the illustrations are much more conservative, but probably generally around the 5% is what you're looking at with an index loan. And then it just depends upon what that index crediting actually performs at. But that money that's loaned out is still available to earn index crediting, is what I mean by an indexed or a participating loan. Does that
Awesome.
help? Anything
Thanks.
else to add to that?
Yeah, so that was very technical, Brad. And it's important to know that. But so taking what Brad said, if you look at the illustrations now, they're a lot more conservative. So the likelihood of that loan looking that way is better than it used to be. But overall, as we think about that, right, when we're using participating loans, if most loans are about 5%, right? So in any year that the policy is if we're using 5% as our loan amount, if the policy returns 6%, right? That's what Brad was mentioning, arbitrage. You're actually earning positive interest on money you've taken out of the policy. That's a tough concept for some clients to understand, but I think the heart of the question's good there, and that you're thinking about how likely is it that the projection that we're showing. Luckily, from the regulations that have been put in place, we have to be pretty conservative about those projections, meaning that provided the policy performs roughly what we're thinking it should, that distribution should happen more likely than kind of how illustrations are ran 6-7 years ago. So 5% is a good broad number of kind of what we're seeing loans on index universal lives at this point. But there are another, if you're worried about loan rate, right, which most people aren't, to be honest, but if we want to get really deep into it, if they are worried about a 5% loan, most policies also have a fixed loan option, which usually, if you're beyond 10, 15 years, in this example we're in like 25 years, usually that were called wash loans, where they charge you 2% and they credit you 2%. Now, the only downfall of a fixed loan is that money comes completely out of the policy and will no longer participate in the index credit. So most people, provided that the policies perform pretty well over a 20-25 year stretch, they're probably going to elect to do the participating loan because they know that the policy can sustain it. But if you get a client that is really worried about that loan rate, we could leverage a fixed loan. There's less risk in that per se, but also when you take a fixed loan out, that money comes completely out of the policy.
Okay, perfect. We got, looks like 2 more questions, but great questions, everybody.
Absolutely.
So, the next question are crediting strategies. So like with indexed annuity, for example, you can actually change those yearly in most cases, or every other year, depending on the indices chosen. In an IUL, can you change the crediting strategies over time
Yes.
with what the client's in?
Yeah, very similar to what you're mentioning with the fixed indexed annuities. Yes, you would have the ability to change what the index is that money is going into, usually at policy anniversary. And some carriers will even allow for you to say, new money I want to go into this strategy, and I want to keep the old money in this other strategy, or you could do both. I want to change everything from one to the other. Most people will also then talk about, if we're talking about indexes, you can diversify within indexes as well. Rather than putting 100% into one index, you can diversify even within the IUL policy and put some of the funds into the S&P 500 index, and you put other funds into another index, 50-50, or you can do 75-25. You really have a lot at your disposal that you can um, utilize. But yes, you can also change indexes at any
Awesome.
at times within the policy anniversary.
Okay. Arthur, I'm gonna either myself or somebody will get back to you on your scenario because it's relatively specific. So right now, the last question we have um, basically says rate and cap integrity are important as well as loan rates and caps, policy fees and expenses, and financial stability of the carrier. How do we, us, you are brokers, us at Western Marketing, go about determining which specific products are best in all of these areas? Um, Brad, I lean on you for a lot of a lot of recommendations, so I'm gonna hand this one off to you at least first.
Yeah, I would say it goes back to kind of what I mentioned earlier. I mean, we've got 40 plus carriers that we work with on the life insurance side, and it really comes down to each individual scenario, and we're going to run um, that scenario through our software and say, hey, here are maybe the top three carriers. Let's have a discussion about these three carriers, what the benefits are on the front end. Maybe they've got some nice features related to um, their operations or their underwriting, new business process. And then on the back end, yeah, we can absolutely poke around at different carriers in terms of what their rate integrity is, their caps, their participation history, different things along those lines. What are their financial stability? I mean, we're working with very, very large organizations. Most carriers that people have heard of that are known throughout the country, that have really good ratings that they post on their websites or different things along those lines. So, the recommendations that we're providing to you, just know that we've vetted them. They're carriers that we are using on a very regular basis, not just new carriers that are coming on board, kind of like what Kyle was saying earlier, that are just throwing out a flashy product at us. We're
Mhm.
utilizing well-established carriers.
Yeah, I just want to add to that. So as Brad said, we're going to give you in a lot of instances more than one carrier, but we go deeper than that because we often in communications with the carriers also know how they're treating agents, right? So if they aren't treating you as the agent well, if they aren't responsive, etc., we'll at least have that conversation. If we get complaints about claims paying, we might still include them, but we would have that as a caveat when you're talking to me or my team about, is this the right cure for your client? So we try and do a good job. And the key here, and I can't stress this enough, is we treat every case you bring us as its own case. We don't go, well, the last case we put with North American, they're a good carrier, so we just do a North American illustration and send it to you. That's not how we work. Every case stands on its own merits and is looked at individually. And I think that's what the I don't know, not trying to get dramatic, but the beauty of what we offer you is we don't rubber stamp stuff. We start from scratch every time and try and give more than one options, unless there is only one option, and then we'll let you know. But very great question. That's probably the most questions I've had in a year, in the last year doing webinars. So really appreciate that. So that was the last question. I want to quickly, because I know we've had you for a long time, explain a couple things. First of all, again, thank you for participating in this, to all of you who sat through the webinar, as well as Brad and Kyle. This is the first of an actual three-part series. So if you are interested in learning more, you're going to receive an invitation in late February, and it's going to be more on sales strategies. So, right, we teach you some about the basics of IULs today. In about a month, we're going to teach you how to position them more in sales. And then the last one in March is going to be on guaranteed universal life, which is similar but not exactly the same. So if we piqued your interest, if you're either wanting to get into life insurance or IULs today, or you've sold a couple but you just want to build your knowledge and confidence, I would strongly recommend as those are available, participating in those. Yeah, here at Western Marketing, our partners at Brokers International really appreciate you, our agent partners. Without you, we don't have jobs, right? So that's not lost on us. If you have questions or you need anything, please feel free to call myself. My name again is Jim Codney. I'm National Sales Director. On a day-to-day basis, I manage our life and annuity team, or we have Amanda and Tyler Marr, our two other marketers on the life and annuity team. Our office number is 800-852-7152. Again, 800-852-7152. So with that, everybody, thank you so much. Brad, Kyle, thank you for your expertise and your guidance in IULs. And I just hope everybody has a great day. All right. Thank you. Bye-bye.
Thank you.
Thank you.